Yeah, let's dig into this new report from Cushman Wakefield. Midpoint 2025, uncertainty looms. Again, as they said, stay alive until 25. Well, if you are listening to this, you are still alive, but maybe not faring as well as you had hoped. Um, you know, and before we even started this, I asked Matt, should we talk about the recent conflict in the Middle East between Iran and Israel? Not because it has anything directly to do with commercial real estate or multifamily, but certainly adds to the stack of uncertainty and could easily impact bonds and interest rates. But that title of just more uncertainty is absolutely correct. But let's first get into this report from Cushman Wakefield.
Yeah. They note a little bit of that larger uncertainty with the trade and foreign policy, but not necessarily like the war aspect, because that is a big question mark. They just, to kind of summarize the economic policy angle, there are higher tariffs. This is all up in the air, kind of, and that's why these are just areas of uncertainty that they cover here in the Cushman Wakefield point. But it's still a good point that they're making, and I'm glad that they're laying everything out here on this page, and it's hard to. It's almost difficult to comprehend how much movement and how much little things are shaking things up right now. But just to name some highlights: higher tariffs, lower taxes, fewer regulations on the policy side, potentially privatizing the GSEs, which are like Fannie and Freddie, and that could result in 20 to 25 basis points of upward pressure on mortgage rates. And then also on the tariff side, there's this lovely chart here that shows potentially tariffs moving from currently maybe 17.5% as an estimate in tariffs. And then by July 1st, 2026, we're going to see a sharp drop in tariffs. I don't know what they are attributing that to, other than, what did they say? We assume it will continue to decline as trade deals are negotiated. So let's just hope that those trade deals are negotiated. But I'm not sure if it's going to be trade deals being negotiated or some other mechanism that may bring down tariffs. I'm not going to.
They started seeing some of that tariff revenue actually come in and start spiking. So I think there's some folks in the administration that are probably going to see that revenue as a little bit sticky. I think that the tariffs are going to come down because they're going to get negotiated. But I think that they like the idea of keeping certainly elevated tariffs compared to the prior administration, because otherwise they can't pass any of these bills and spend the money and do the programs that they want to do, even with some of the cuts that they're doing, because they need the math to pencil in a way that the CBO can check off on it. Not that the math makes sense or that actually maths as reality, but they need to have the story and be able to say we're going to be able to make the revenue up somewhere so we can do these other programs. But I think, are people over talking about tariffs? Are we done?
I think we're done talking about tariffs.
Until we're not?
Yes. Until we're not, but yeah, I think we're done talking about tariffs. I really desperately want to.
I think everyone is. I think the Trump administration is sick of talking about tariffs. I think the entire international. I think the world's sick of it, and they're just like, fine, it's not great, okay, but whatever. It's a lot of other countries do have tariffs. I mean, I'm in Turkey right now, and they've got some random tariffs on random things. I mean, like if you get a cocktail, it's like a $30 cocktail, just like the hard alcohol has a tariff on it.
Oh wow.
In a high tax on it. So again, different countries, are different. I'm big anti-tariff person generally. I'm a big anti-tax person, so tariffs are taxes.
Exactly.
Get in the way of. I want to do trade. Let's trade. I want to do. You and I, we want to trade. We shouldn't, unless the government is involved in that process. I think the better. So, but that's me.
So maybe
stagflation, Matt.
Perhaps related to, perhaps not, but there's a little more detail on the potential for stagflation, and Cushman Wakefield say stagflation signs are already emerging. There are some elevated layoffs, maybe some contractions in manufacturing. They say that confidence is off recent highs, but this does not reflect the more recent University of Michigan increase in consumer confidence. So that's a little bit more promising. But this is interesting. It shows that the foreign origin increase in prices since March 2025 is up to 2.5% compared to 0.5% of domestic origin price increases. It's not 17%, but it is a little bit is a little bit more. I think that this is not necessarily a like sharp dagger pointing to stagflation, but it is a little bit, it's a little bit of worrying signs. I don't think that we're going to lead to full blown anything. Maybe just a little bit more raising prices. I have trouble thinking that tariffs are going to lead to anything dramatic, just based on how the policy has progressed and the reactions from the economy and the alterations from the administration. And I kind of think, well, if there's going to be some drama in the economy, I think there's going to be reaction from the administration, but also how are they going to implement all of these ever-changing rules and regulations on tariffs? I don't know if DOGE had an effect, if they improved the efficiency and fired a bunch of people that were in charge of collecting tariffs, but like that, I think that's an open question. Is what about the enforcement?
Are they going to start the external? They're going to start the external revenue service? They announced that. I don't know if that's actually happening or not, but they had this idea.
But at least then that implies, okay, good, because that's another layer of bureaucracy that has to be set up in order to process all of this, I would think. And maybe it's just something on a computer. You just say, well, it was zero. Now you just click on the 10% tariff button, and then that's all you need. But like, I'm just thinking of, these goods coming off the truck, and you got to have someone scanning them in or something, and or checking up on people. Who knows?
Yeah, if the government could do anything that simple, Matt. I mean,
exactly.
Different administrations, before, but you remember healthcare.gov?
Yeah.
Remember how smooth that was?
Totally.
The website. Yeah. So this is a little more complicated.
And this is just a kind of put a pin in the stagflation suggestion here. They are expecting a little bit lower in GDP in 2025, and then a real bounce back in 2027. That seems to actually be the thrust of their outlook throughout all of the different real estate sectors they cover in this, whether it's industrial, retail, office, not as much multifamily strength actually, but for all the rest is like there's going to be a little dip in 2025 and 26, and a recovery in 2027. Well, kind of back to normal then. I think that multifamily is ahead of the game though, and I just kind of want to skip to that if possible, because I don't want to.
Can you imagine, Matt, going back to 2020 and saying, we'll basically have gotten through most of this, not necessarily the wearing masks piece and getting a vaccine, but the economic disruptions, will be not necessarily normalized until 2027 is beyond me, because I still feel like we're living in this post-pandemic world of uncertainty, inflation, and in a new paradigm in macroeconomics that no one really has the playbook, as Jerome Powell said in a speech. I think it was last year. I mean, we continue to navigate.
Navigating
by the stars. Under cloudy skies, and while
I have like an audio
clear
clip of
here and there. I know it's great. It's best. We got to put it on the wall. But I mean, again, the clouds clear every once in a while. You get little bits and pieces, but no one has the charts to be able to navigate this with any degree of confidence. That's why the Fed has been so flaccid in their ability to make any decisions. But rates. If you look at where actual CPI inflation is right now, rates probably should be lower. I think we have this boogeyman of inflation.
I think
Sorry,
Powell has a real opportunity to lower rates. That'd be so bold. It'd be so cool of him. But he must be hockey is fine.
Well, they said they were going to do it. They said they were going to do it. But now let me ask you this, Matt, just so we can get into some hot takes. Yeah. Do you think that there's any politics that are weighing in on the decision, because it would appear that it would be an appeasement to Trump if Jerome Powell and the FOMC lowered interest rates? Are they holding steady to
that's like the double psychology.
Project independence?
Yeah. Is there holding steady in itself like an admission that they're being influenced and not independent? I don't know what the psychology or like the kind of social political struggles are informing that decision.
Trump should tell Powell to raise rates.
Yeah, exactly. That would be good. I think that there's a good case though for them not to, or for them to lower rates, because the softening that we've seen in the CPI, the lower prices in the CPI, and the suggestion that maybe all of this is because people are kind of hunkering down and reducing their consumption is, that ain't no runaway inflation. And I think that that's also seen in a little bit softer employment market. However, like maybe there's reason for them to keep it the same because it's no emergency yet. I don't know how much they want people to hurt. I think that we're done. I'm done like trying to expect to feel pain. I don't want that to be a part of the Fed's calculations anymore. But whatever. I just have this industrial fundamentals outlook up here, and because I just wanted to go through all of these sectors really quick. They expect vacancy to peak in 2026 and then start to go down in 2027. This is notable. I wanted to note it here because industrial has famously been a really strong performer in the past few years, stronger than multifamily in many cases. But in this point, their headline is softer for longer. So that contrasts with multifamily, where they talk about how demographics favor urban revival and strong structural tailwinds continue. There's lots of reasons for multifamily to be doing well, whether it's household formation, fewer adults living at home, or just other demographics that are pushing people towards some gateway markets, and actually some. So it's the bigger cities and these exurbs and emerging suburbs, a little bit away from the urban core, which kind of makes sense with the aging millennials moving out, maybe looking for something more suburban.
I've been at multiple conferences, Matt, this year where there's been a lot of discussion as a return to the urban core. And I mean, I'm seeing it in real time. The rents out of the suburbs, I mean, we talked about this earlier, but the rents in the suburbs aren't necessarily cheaper than downtowns anymore. I mean, there are some apartments in downtown because a lot of supply was built downtown. Then everyone moved up to the suburbs, and they have not been able to grow their rents, and they've lagged behind. You get some concessions. Whereas like the really brand new fancy apartment out in the suburb in these little like mini suburb cities, you could be paying a pretty penny because you're getting into the nicer school districts and you're getting into a little bit different, nicer, depending on who you ask, quality of life. And there probably are some deals in these urban environments. Cities aren't going away. We've talked about this in the past. There's always going to be a drive for, the social theater, being able to have a high degree of walkability, being able to go to work. The whole reason why people live in cities. Maybe it's just young people, but it's also a wide swath. It's not going away. Maybe there's more of a balance between urban and suburban. But I think that could be a really good call to look at some of these urban markets. I mean, I still prefer
kind of
the
agree,
suburbs
actually,
because just the older demographics are like they're moving out of some of them are moving out of the city. But all these Gen Z folks, they're not necessarily thinking that way. They still want to live in the city. I mean, again, affordability is going to make it more feasible. And there are people like that are thinking, hey, I've lived in the suburbs. I want to try this city thing, especially a lot of empty nesters. Again, their kids go to college and they're like, we don't need this 4 or 5 bedroom house. Let's sell it. Let's get a place downtown, whether it's a condo, townhome, apartment, whatever it may be. So I would not count cities out. It's not our core target right now. But I think there could be a strong thesis for it.
Yeah, no, I totally agree. Just to sum up here, even their expectations for vacancy is a decline. So where industrial had a little bit of a jump up in 26 and then it went down in 27, for multifamily, Cushman and Wakefield expects declining vacancy in 2026 and in 2027, pretty consistent improvement in multifamily fundamentals. Just to push through really quick, office, they talk about jobs being down, expected to grow in the next couple of years. Some data show other data show RTO stability. Return to office at about 30%. Some data shows that people are increasingly returning to the office. I think that it's more like we've reached a equilibrium essentially with 30% of full paid days are work from home days in the job market. I don't think that it's going to change very much soon. And the upshot of this all is increasing vacancy. They are really expecting vacancy to peak in 2026, but be flat and remain elevated in 2027. No recovery essentially yet for the office market, but nothing, horribly worse. It's not disaster. It's just not great. And then retail, to close this out, retail also faces mixed wins. So to summarize here, industrial, a little bit of trouble. Office, a little bit of trouble. Retail, a little bit of trouble. Multifamily, it's doing okay. So I like that. That's nice, at least from the perspective of an apartment investor. This though is interesting and may have implications for the apartment market. And I'm glad they noted this. It says stress is showing. This is the 90+ day delinquency rate for all these forms of consumer debt, whether it's mortgage, credit cards, HELOC, auto loans, student loans, and other. This big jump in student loan delinquencies is because student loan repayments just started. That is a quickly developing data point, and that may yet have an impact on the apartment, because this is a renter population, recently graduated. They still have some student loans to pay off, and it only recently started kicking in. And I don't even know if there's probably people that haven't yet paid student loans and they're not yet being penalized for it. Once they start being penalized for it, once they start kind of noticing, all right, I got to pay these now, that may mean that they are shopping for cheaper apartments. I don't know. But that's just something that stuck out to me. Also, an increase in credit card delinquencies that really shot up from 8% in 2022 all the way up to 12% now. 4%, maybe that's not a lot, but it's proportionally, that's 50% increase. And what's the other? Okay, the other, it is an other section. So I can't really ascribe anything to that, but it does seem like debt is increasing, even though consumer balance sheets, this financial obligations as a percent of disposable income, is relatively stable. Just seems shaky is the point from Cushman Wakefield.
I wonder if that other is, a lot of the like buy now, pay later options that you've seen, pop up in the last several years.
This is
that's always worried me, because I'm assuming a lot of people do that, and all of a sudden they have a stack of bills to pay come 6-9 months later.
It does seem like this kind of sleeping thing with high interest rates, how, if you were using credit cards for a certain amount of purchases before, like a few years ago, and all of a sudden now you can't make those credit card payments, even if the prices were the same. Let's say you spend $300 a week or $200 or whatever, depending on how big your family is or whatever. And if you charge it to the credit card, well, those credit card payments in 2022 are going to be a lot different than they are now because of higher interest rates. And it's this.
You mean that? I thought everyone just paid off their credit card at the end of the month. That's what everyone says they do.
Well, they say they do it. They say they do it, and then they have that money set aside. Well, okay, it costs this much to pay it off, and then it snowballs, and you kind of don't, and you don't see it, but you feel it. and then maybe you notice. But that is one of the reasons why retail fundamentals are they're expected to, much like industrial, kind of jump up a little bit in 2026, and then vacancy for retail jumping up in 2026 and then going down slightly in 2027. So shakiness, not as consistently positive as multifamily, but not as consistently negative as the office. And they at the end of this they have this mid-year overview. They talk about what it means for occupiers and investors, and they have some summative comments that is very general, but they're talking about keeping your eyes on the horizon, or focus on or reassess investment strategy. But I appreciated their viewpoint here, and the way that they highlighted the different performance and the kind of shakiness that we may see. I'll put aside all of their calls, generically or not, to like make sure you're doing a good investment at the end. Like that's maybe a lesson learned. But the fact that they are across all these different sectors are saying, 2026 may not be as strong in every area of commercial real estate as one might think. I think that's an important realization, an important thing for investors to consider. Maybe not multifamily investors, because
Yeah, well, I mean, the economy it's uncertain, as we've said a million times, but again, you have to have a little bit of a longer term outlook, and with the elasticity with housing brings a little bit greater confidence for multifamily over a longer period of time. I think the tough part that is keeping some capital on the sidelines, and then we're gonna wrap up after this.
Yep.
Just don't know if there's gonna be another leg down. Is there going to be that recession? Is there going to be that inflection point?
For
is
sure.
that from, loan maturities? Is that, as we discussed, if there's a real true total war scenario in the Middle East, what does that do to oil? What does that do to consumer confidence? A recession doesn't increase the value of real estate in the short term. Again, long term, the fundamentals don't change materially, but that uncertainty of, do you want to jump in right now before prices are going to go drop even further? Again, if you have a long-term hold period, it matters much less. But everyone wants to get as low as basic as possible. Everyone wants to be able to deliver a high rate of return. And with high interest rates, it's difficult to be able to deliver a projected level return that meets the degree of risk that is in the current market, especially with the assumptions that you have to make today, just because the range of probabilities is so much wider. So it's hard to make those decisions. It takes a lot of clarity of thought. And it takes an investor that's willing to say, I'm all right if not everything goes according to plan in the first 18 months. This is a 5 to 10 year hold. We're going to see through it. And this real estate is going to be worth significantly more in 5 to 10 years. Rents are going to be significantly more given demographics, given supply, given the inelasticity of housing. But
just go with the flow.
You have to be very solid in your convictions. Yeah, just go with the flow. I hope we don't get any copyright strikes. I mean,
no. Going with your convictions
it's all fair use.
Right? Yeah. Oh, of course. No, I think that going with your convictions is a lot different than going with the flow. You want to be able to have confidence in something that you know a lot about, that you're able to kind of work hard to ensure the success of the investment, rather than going with the flow and expecting the outside circumstances to bring you to success. But that's just my own thought. I'm not going to read into the branding of flow there, but I do think that one has to be a little bit more intentional and a little bit more proactive when you're investing, rather than passively drifting along with the currents, if I can stretch that metaphor.
Love it. Love it. Well, Matt, again, great slate. Talking about flow is always interesting, and I think it flowed really well into the other pieces.
Nice.
Just before we leave, because I have to run. I've got a great view right now, Matt, that I just wanted to share with you in the viewers. Listeners, I'm sorry. I'm just going to have to just explain what we're seeing out right now. And just cradle of civilization, and of empires. I don't know if you can see this, Matt, but got the Hagia Sophia just right over there. It was a church. It's for 1,000 years before it's converted into a mosque. I've got the palace over there. That's Asia.
Yeah.
I'm in Europe. Europe's right here. It's a wild place. I saw Byzantium, exactly right here. I mean, we're basically the Roman Empire. Rome continued right here, Matt.
Yeah.
I saw a obelisk that was erected by the Romans in 390 AD, but it was a 4,000-year-old Egyptian obelisk.
Wow.
Sorry, 6,000 years old. It's from 4,000 BC. 4,000 BC. So it's 6,000 years old. I think they had some help. Some help. It looked the condition that the obelisk is. It's incredible. I'm like, the bridges around Indianapolis that are 60 years old are crumbling. This thing.
We need some ancient aliens to help us with our potholes.
Seriously, I don't know what they were using, but it's different from what we use today. Well, thanks everyone for watching this great episode. Make sure you like and subscribe. Leave a couple comments. Let us know what you think, especially on flow. I'm curious of everyone's opinion, and also just where the market is going. And are you looking at making allocations of multifamily this year or not? And if you are, make sure that you are subscribed to the Gray Report newsletter. You get in touch with our investment team at Gray Capital if you're an accredited investor. Because we're looking at deals. We do have a lot of confidence in the market over the next decade, and we're going to take some actions here pretty soon, so you're not going to miss out if that is on your target list. So thanks again for watching. Catch you on next week's episode.
See you.